UK house prices are overvalued, which is why prices are falling across the country. But the big question is, how much do they need to fall? And where in the country are they most overvalued? The answer depends on who you ask. Some property experts claim only a very modest fall will come. But at the other extreme, some claim that there could be a fall in prices of up to 35%. In this video, we'll look at what all the data shows us, and we'll examine the more extravagant claims that prices could drop 35% from peak to trough. In the aftermath of the 1990s recession, UK house prices to income ratios were less than 3. But over the next 3 decades, prices rose faster than inflation and also much faster than wages, reaching a peak in mid-2022. The ONS method states that house prices were nearly 9 times average incomes. And so it's no wonder that the younger generation have all but given up hope of ever buying a house. The primary reason why prices rose so much and became so overvalued was we had a period of ultra-low interest rates. In 2021, just a couple of years ago, mortgage rates were around 2%. And you could argue that people who took out a mortgage in 2021 were being rational. If it's so cheap to borrow, why not buy? The only problem is that after 15 years of pretty much zero interest rates, there was then this new inflation shock. COVID, rising energy prices, high demand, all caused unexpectedly high inflation. It caught the Bank of England off guard, and the result is we've had 14 consecutive rises in interest rates. Recent falls in inflation have been somewhat welcome, but they haven't altered the big picture, that mortgage rates are at least double what they were a couple of years ago. The economics of the market has changed. Zoopla report buying power from first-time buyers has fallen 20%. Other calculations suggest it could be as high as 30% less buying power. Supposing you could afford £1,000 a month mortgage payments. In 2021, with a rate of 2%, you could get a mortgage for £270,000. Now that rates are 5%, the same monthly payment would only get you a mortgage for £186,000, a 30% decline in mortgage affordability. Now, that doesn't mean necessarily house prices are going to fall 30%, but it does give a clear indication of how the changed interest rates have affected the market. If we look at the ratio of mortgage payments as a share of income, there's been a clear fall in affordability. It is getting close, although not quite as bad, as the last 2 crashes in the early 90s and 2008-09. If we look at affordability of housing in the long term, we reach a level not seen since Queen Victoria was on the throne. Yet so far this decline in affordability has not really been reflected in prices. It's true that house prices have fallen 5 or 6, 7%, yet mostly the shock decline in affordability has led to a decline in the number of housing transactions. The market is almost grinding to a halt. Sellers who don't want to reduce their prices are struggling to sell, and housing chains can easily fall apart. My parents have been trying to move since February of this year, and on 2 occasions the housing chain has fallen through. Gazundering is on the rise, and people can soon lose their mortgage deal because of rising rates. One reason prices are still overvalued is that the market is slow to react to this change in economic fundamentals. The housing market is more like a big ship. It's very difficult to change direction, but once it does, it's got a lot of momentum. Now, with the housing market, it's always possible to find an example of a big house price collapse and individual cases of even house prices going up. Why is this? Well, firstly, the housing market always has and always will be very regional. So far, house price drops have been concentrated in the south, because that is where house prices are most overvalued. It is in the southeast that mortgage owners are most affected by higher interest rates because they had to take out much bigger mortgages to buy the more expensive housing. There's a huge divergence between house price to income ratios in, say, Scotland and those in London and the southeast. And another thing to be careful of, it's very easy with the housing market to be guilty of confirmation bias. If you want to look for evidence that house prices are falling very quickly, you can definitely find some examples. On the other hand, if you want to feel that house prices are going to stay the same, again, you can find individual cases. What we have to do is look at the big picture. But whether you're an optimist or a pessimist on house prices, there has been an underlying shift in the economic fundamentals of the market. Buyer demand has definitely fallen, but even if we're close to the top of the interest rate cycle, we still haven't fully absorbed all the past rate increases. In the coming months, there are still millions of people who will remortgage to significantly higher rates. they've been protected by 2-year fixed mortgages, but that will change next year. And already there's a lot of evidence to suggest that homeowners are making pretty drastic changes to their finances in order to meet the higher cost of mortgage payments, using savings, reducing pension contributions, switching to interest-only mortgages, extending mortgage term, and this will only become more common next year as homeowners try to deal with the changing conditions. Interest rates typically have a time lag of 18 to 24 months. So 2024 is going to be a grim year for many homeowners and the housing market, and this will feed into lower economic growth and lower spending. And I think that economic conditions are another important factor which will affect the housing market next year, because in recent months the housing market and the rental sector have been to some extent buoyed by fairly strong growth in nominal wages and a good labour market with low unemployment. But the big question is that now set to change? The Bank of England forecast for the UK economy is almost stagnant economic growth and a small rise in unemployment. But I think there are reasonable reasons to be more pessimistic. Real wages have fallen considerably in recent years. It will take time to change that. The impact of higher rates still are yet to be felt. And if house prices do fall by 10-15%, that will also have a big negative effect on economic growth, consumer spending, kind of a negative spiral of lower growth and lower house prices feeding up on each other. And that definitely happened in 2009 and the early 90s. But another consideration is that even if we avoid another technical recession like we did this year, the effect of all these interest rate changes and house price falls will not be felt equally amongst the economy. People who've paid off their mortgage, people with high savings, will actually be do fairly well next year. But those with loans, homeowners who have just taken out a mortgage, and also business who have taken out a lot of loans, they will be really squeezed by the higher interest rates. And it will feel like a recession to them because they will have less disposable income. They will less be able to buy housing. Now, I should add the usual caveats when making economic predictions. Last year, the Bank of England actually forecast a recession for this year, and just about we've avoided doing that. The economy was somewhat more resilient than expected. But there's still a lot of headwinds next year, and many economists are still pessimistic about the struggling UK economy. And this will definitely feed through into the housing market. Now, interesting question. What about the forecast that house prices may fall 35%, peak to trough, made by Charlie Lamdon? His reasoning is threefold. Number one, interest rates have risen back to more normal levels and are likely to stay there. Number two, all the real wage falls of recent months, and the deteriorating economic circumstances, which will exacerbate the other factors. Now, firstly, I admire people who make bold predictions, bold expectations, but are very far removed from, you could say, the conventional wisdom. It's easy to be subject to groupthink, and there's a saying of John Maynard Keynes, I think it's Keynes, who said that it's better to be wrong in the majority than right in a minority. So it is interesting to come out with a prediction that's quite different to more pessimistic than, you could say, the industry average. Now, I think in a broad sense, Charlie Lamdon is right that market conditions have changed fundamentally and there will be a housing market correction. There has been a significant rise in interest rates, falling real wages, and the economic prospects are fairly grim. Nevertheless, it's hard to see a 35% fall in nominal prices for quite a few reasons. Now, I should add, I'm not a big fan of making predictions myself, but when I was on Talk with housing optimist Russell Quirk, he made me make a prediction, and I said my best guess was 15 to 20% fall in nominal prices, peak to trough. But anyway, reasons why I don't expect a bigger 35% fall. Firstly, high inflation itself will improve affordability, because we're talking about nominal house prices. So with nominal wage growth of 8%, this is going to increase affordability. It's going to reduce house price to income ratios, because you can reduce house price to income ratios two ways: falling house prices and or rising wages. Now, I don't necessarily expect wage growth to maintain at 8%. I think next year, as the economy slows down and inflation slows down, we'll also get lower wage growth, but it will still be positive. Secondly, although buying power has fallen 30%, this is offset to some extent by a desire to escape the rented sector and do whatever it takes, if you can, to buy a house rather than pay a fortune to rent. When we say that house prices are overvalued, what do we mean? Well, one way to judge overvaluation is compared to the alternative. Now, recently, higher interest rates have made buying more expensive than renting for the first time in 15 years. But it's important to bear in mind it's not 30% more expensive than renting. So those who can buy in the future by getting a longer mortgage term, borrowing from a parent, they will do if they can. For example, if we go back to our early example, if we change our mortgage term from 30 years to 40 years, we can borrow an extra £20,000. Hardly a panacea, and it's going to be really more expensive in the long term, but it still is a factor. And I think that a more important factor for a long-term rise in the house price to income ratio is the amount of money put into the housing market from parental wealth. That might decline a little bit next year if house prices fall, but it's definitely been a factor in why there's more money and more deposits than you might expect. Thirdly, if you look at the past house price correction in the early 90s and 2009, their nominal house prices fell 20%. And I don't think we can say that conditions are much worse than in the early 90s, unless there's a very deep recession and a rise in unemployment towards 8, 9, 10%. It would take a lot to get arrears to become close to that very high level we saw in the early 90s. And also in the 1990s, a lot of the house price to income ratio decline came from rising incomes. And it's very interesting that it took 5 or 6 years before the housing market recovered. Also worth bearing in mind that if we take 2009, where house prices dropped very sharply, it was around 12 months after the big interest rate increases of 2007, 2008. I think another factor is that if the UK was to see a deeper recession than forecast, which could easily happen, then that would have a negative effect on inflation. It would help to bring inflation down quicker. The Bank of England already predict inflation of 2% by early 2025, with the caveat that Bank of England forecasts have not been very good. But if we do go into a deep recession and a sharp rise in unemployment, inflation will definitely fall. And if we did get a deep recession, a sharp fall in inflation, I can't see the Bank of England keeping interest rates at over 5%. Let me explain why. For the past 15 years, we've had negative real interest rates. The nominal interest rate has been less than inflation. If inflation is 2% and the economy is in deep recession, will the Bank of England really keep interest rates at 5%, which is a real interest rate of +3? It's unprecedented by recent generation. It would be quite damaging to a deeply depressed economy. So I think it would be unsustainable to have very high real interest rates for a long time. Now, you could argue that we have higher structural inflation now. And if oil prices rose back to $150 a barrel, like we saw in 2022, it would cause another bout of cost-push inflation. But I still feel that a deep recession, falling house prices, high interest rates would all bring back some of the deflationary pressures we saw in the 2010s. But at the moment, markets are still predicting interest rates remain high for quite a long time. So anyway, this is generally why I'm less pessimistic than Charlie Lambden on house prices. But it's an interesting person to follow in the housing market, get interesting ideas you might not find elsewhere. But in general, when it comes to anything about the economy, it's always, you have to be careful about relying on one source, because everybody, including myself, has a degree of confirmation bias. We look for what feeds our expectations and what we might have said in the past. So to conclude, I do feel that house prices are overvalued, and this is shown in quite a lot of data. And we've not yet fully adjusted to the new economic conditions. But there's going to be no sharp drop in prices overnight, because the housing market is quite slow to change. In the coming months, I think the house price to income ratio will fall, but it'll be a combination of both falling prices and rising nominal wages. But what should we do if we were a buyer or a seller in this difficult market? Well, it's a good question. This video here goes into more detail about the different options that you have, and it's a very tricky decision to make, but hopefully it will give you some information to work with. So thanks for watching, and see you soon.